Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how going? It's Phil Tarrant here. I'm co-host of the Pure Property Podcast with Paul Glossop. He's in the studio, looking lean, mean, property fighting machine. How's it going?
Like it.
You like
good,
it?
mate. I'm very good. It's a busy start to 2025 for a variety of reasons. Probably
Pretty
more
much,
so
man.
than we've seen in quite some years. Back in the heady days of 2020, 2021, when there was nothing but news headlines going on, and left, right, and centre there was something changing. But it's been status quo for probably a good couple of years, and not huge amounts of changes in the money markets, the property markets, and all the other things that support that. But only as of literally the last 6-8 weeks, it seems like there's been a flurry of changes, including most recently some pretty big weather events that are happening and have happened over the last few weeks and months as well. And thoughts to those who have been affected.
Yes, no, absolutely. And we'll get into Cyclone that's sort of just about to hit landfall as we record up on the Queensland coast. And that's pretty significant. I haven't seen people be so alert before, like in a long time.
Headlines
so
everywhere.
something like it, and you must see it because of probably the algorithm on your interweb. But the surf there, Kieran, I know it's the surfer's guide to property investment. I don't know how many people are investing in property at the moment. I think the whole of southeast Queensland around Kira and
That were just
Currumbin and
surfing.
stuff, they're just surfing.
There was a fair bit. I know friends who actually went up to Noosa, Double Island, and basically everywhere from there right down to the Snapper, and even down to Coffs Harbour Breakwall with just a really, really handy little right-hander just peeling down the breakwall, which you don't see very often. That was on the socials
Noosa
yesterday.
look good. Like
Noosa
people reckon
fun.
it's all time.
It's so busy. I've surfed Noosa a few times, and man, it's a busy old place, especially when the swell's up.
Yeah, well, what's the metaphor of a cyclone swell and property investing?
Well,
Considering your book.
let's go. Interest rate changes and zoning changes coupled with population growth and limited supply.
Yeah, well, you've teed me up because I'm introducing my executive decision. I'm going to introduce a new compartment of the Pure Property Podcast, and that's going to be the Pure Property News Update. And how good's that little jingle? Our team's been working on that for years.
Decades.
Trained.
Happy to hear feedback too, by the way. People think it's the decades worth of work.
Decades worth of work there, and I'm really happy with how that's come together. And it is a real professional outfit here at Momentum. Considering we've got probably more podcast brands than anyone else.
Excluding yourself, everyone else does a stellar job.
Yeah, everyone does a stellar job, but no, a structural way for us to chat about every single month what's been happening, and we sort of spoke very briefly around the cyclone that's about to hit up in Queensland. Yeah, do you know what I did hear about that though? Originally, it was going to be called Cyclone Anthony, and the government called up and said,
"Not ideal,"
and said,
"This is election season, people."
Whether that's just a rumor or misinformation or whatever, or some folks from the Liberal Party sort of told me that just to entertain him. But that's what I heard, by the way.
Right.
So,
okay.
but
word on the street.
But talking about, there is an election coming up, and as we're recording today, I believe there's Western Australia goes to the poll pretty quickly, and I would say there will be a date announced for the election probably pretty quickly as well.
Shortly thereafter. Yeah.
So stand by. Mid-April is what the pundits are saying for the federal election. So that's a bit of the news. But, the Pure Property News Update, here a little bit more locally close to the home, as in we're recording in Sydney, there were some significant changes to zoning legislation in and around certain parts of Sydney and sort of wider New South Wales. This is a big deal, but not so much a big deal. Tell us about it.
Yeah, it's something that's been in the works for some time, and anyone who owns property across Sydney or the broader New South Wales market and has maybe considered developing it and has kept a close eye on this space probably has seen a little bit of news over the last 10, 12 months where the New South Wales government made some planning announcements basically this time last year and looking at changes to density in R2, R3, R4 zones, particularly though more so around what they deem to be the transport orientated development areas. So they were deeming those to be within certain proximities to either train hubs, bus hubs, or just general hubs of suburbs in general. So you can envisage somewhere like a major Westfield shopping centre or a train station or a metro bus stop in some of the areas towards the northern beaches, as an example, who don't have train lines. There is R3 areas now within, so some of the big headline aspects of that, R3 zoned markets, which previously were considered and still are considered medium density, if they're now within 400 metres of those TOD or transport orientated development areas. They now have had their zoning density changed, and there's obviously a lot more specificity around the particulars here, but previously it was what's deemed to be 0.7 to 1. So to put it in layman's terms, if you had a 1,000 square metre block, you could build up to 700 square metres of actual floor space area on an R3 zone. Basically, that was the blanket rule. That has now changed in some areas absolutely dramatically. So where that's changed, if you're within that 400 metre deemed zone, and there's 171 suburbs on this list where these changes have occurred. So if you want to look at it, get onto to the New South Wales Planning website, and there's a lot more information there. We've also got a lot of information on the Pure Property website about this as well. You can reach out to us to discuss if you do have anything that you think might be impacted. Happy to discuss it with you. But the 400 metre zoning of each of those suburbs has gone from, if you're R3 and 0.7 to 1, that is now changed to 2.5 to 1 and up to 6 stories. So to put that in perspective, what was previously 1,000 square, go back to 1,000 square metre lot, you could build up to typically 2 stories, potentially 3 stories, depending on where you're located. And that was up to 3 stories, more or less, with a ground floor would be a garage, then first floor, second floor.
So you're talking like townhouses?
Townhouses, terraces, that type of, if you put your mind to that type of thing, that can now go from that to 2.5 to 1. So that same 1,000 square metre block in that same location, but if it was now within 400 metres of one of these 171 suburbs, can have 2,500 square metres of floor space area. Now, this is going to change the landscape of a lot of markets across Sydney, all the way up to more or less Newcastle, down towards the Illawarra, and everything in between. There are allocated areas which has already been gazetted, and that will now be underway. In some cases, people have won the lotto here.
Yeah.
Owners who hold property within these areas, some of them may strategically have thought this is at some stage going to change. I personally do have property that has been affected by this, and I'm going through all that aspect personally now to go through some changes. But with that, you've also now got to consider some people have had a big upside, but whilst some, and I'll give you an example, there are people who maybe border on an R2 zone area with their home, and their rear neighbour might be an R3. And this happens a lot. And if you look on any zoning maps in particular areas, you will see this, where the R2, there are definitely some density changes, but nothing like what has happened to some of these R3 markets. And I can speak personally on markets that I know of and own in, where R3 on one side, R2 on the other. R3 has been affected by this, can go up to 6 stories. The R2 on the other side of the street, literally the rear neighbour that has a separate street going in, will remain 2 stories, but they will potentially have a 6-story apartment block in their backyard.
Yeah.
And this is as of now. So it is a big, big change. Now, it's obviously for the right reasons. We've got this massive target that we've got to try and achieve as far as providing housing, and we need to change density. There is no other way to do this. It is too expensive. It is too cumbersome to keep releasing more land further out in greenfields, an hour and a half, 2 hours outside of major metro markets. We need to use the infrastructure that we've got. However, this has been a big stick aspect of what's going to happen right now.
I reckon most property investors who have deliberately invested in these areas with a view towards this, and nothing's ever guaranteed, right? A lot of people speculate, right? And they speculate and they think, oh, well, the government's going to change this, so I'll do it now. And if we get up, that's great. It's really just R2 to R3. So in simple terms, R1 is like a home, a single level or dual level home somewhere, right?
R2's more common, low density homes in Sydney that you just see in any kind of suburban area. predominantly they'll be R2 zones. R2 has had some changes where they've now brought down the minimum for dual occupancy to 450 square metres with a minimum 12-metre frontage in most cases. So some markets had a minimum 600, some cases 700. That's all been brought down to 450 in some cases.
So like duplexes
well.
and stuff would fall into R2.
Correct, R2. So you'll see this will also allow for more duplexes in more areas that previously were restricted based on the minimum zoning that the local government had enforced, but that is now going to be overruled in a lot of these cases by this new
Are they standardising the width of blocks for duplexes irrespective of where?
There's a minimum that's been reduced. I believe it's down to 12 metres now, where previously in some cases it was 15 metres, depending again on the council though. And the actual density and the ability to build in a lot of R2 markets has gone from 0.55. So again, use that same 1,000 square metre block. You could build 550 square metres, 2 stories of total floor space. That has now changed in a lot of cases to 0.8.
So the big thing is going from maybe like townhouses or terraces or duplexes to apartment blocks largely.
That's a big change. But then there's also the other aspect around there's the next category, which is not within 400 metres, but there's a 400 to 800 metres of those same TODs. They effectively now have also had increased density. So go back to that R3 market that maybe isn't within 400 metres of that train station and is one of those 171 suburbs. They actually still have an increased density from 0.7 to 1.5.
Okay.
So it's not just 400 square metres, it's 400 to 800 square metres. But essentially, if you picture it as a ripple effect, you'll have higher density, and then it will slowly push its way out, and then go into the suburbs that surround it.
So anywhere there's a transport node, a train station, for example, you're just going to see higher rise.
You are going to see more density.
And the point is that property investors be like, great. So if you were the person who owns a property that's been rezoned, it's either made your land more valuable so you can sell it off to a developer, and you're going to have to sit and wait until a developer wants to.
It's not happening immediately.
That's not going to happen immediately,
no
right?
Chance.
So you're going to have to hold on to that property maybe for a decade before.
I'd say that's realistic, Phil. Maybe a decade is actually realistic because these zoning changes, from my experience, they do happen. Yes, you do get an uplift in value, but developers don't go and buy 100 lots in one hit. They do this incrementally, and they look for the best first, as long as it's priced correctly, and then they move from A to B grade to C grade to D grade.
And developers are going to have to be, and good developers are used to this, but I'm with a bit of a fight because, the NIMBYs, as in my backyard.
They're not going to make it easy.
When you sit there going, well, I like the suburb as it is right now. I've been living here for years, and I don't want a 6-story apartment block behind me looking into my backyard. Well, that's just the way it is.
And this is where this has actually got winners and losers too, though, because the losers are going to be those R2s who have the R3s that have been changing in density, and all of a sudden there will be, and it won't happen overnight, but it will happen in the next 1, 2, 3 years as you see DAs go through and you start to see ground starting to turn over and people are like, oh, what's going on? Oh, it's going to be a unit block. And then people will start to think, hang on a second, I don't want to live within that there. So the devaluation of the homes that are directly affected is also going to be a thing. So there is
devaluation.
I don't doubt there will be some areas which will have a massive flow and effect that will be negative versus some markets which will have a positive effect. And this is going to be, I think it has potential to actually be the great reshuffle of Sydney because you're going to have people, the people who are the haves are going to potentially all of a sudden, and I can think of places like the lower North Shore, the upper North Shore, and places that were largely over the last few decades that were protected from a lot of these changes. They've now fallen into these categories, and there is people who are going to be directly affected here who thought this would never happen.
And they're probably going to be the most vocal, probably the most cash up to defend.
Absolutely.
There's going to be a lot of people going, I don't want this. And we don't want to. We're happy with the way it is right now.
Absolutely.
They're happy for development and everything if it suits them. But I would say there's probably in the balance of it, probably more losers than winners.
There will be. I mean, those
initially, because the winners will be people who will be able to now afford to live in suburbs, which traditionally they might not have been able to afford.
In smaller accommodation, and more premium markets and premium locations and lifestyle areas,
and
etc.
it's got a shuffle as well because aging population, and this would have some view to it. That you have an aging population, there is no reason why, theoretically, why a 70-year-old couple who've raised their kids at a home in the lower North Shore of Sydney still need to be living in a
Yeah,
in a
half an
six
acre,
bedroom, half an acre,
acre.
6 bedroom. Like, realistically, those housing should be available for families. And that said, if you go get stuffed, I've lived here all my life, whatever.
You're within the right to say that too.
But facilitating downsizing, which will be it's happening now, but it's going to be, a lot of developers now are building purpose-built downsizing blocks. I see it around where I live, right?
Absolutely.
People cashed up, they're selling these big houses in the burbs, and then they're moving closer into town with smaller 2 and 3 bedroom apartments.
Yeah. And you'll see that this is where I see the direct effect of it. And I can speak personally to stuff that I own and I actually will be developing personally, is that if you're in an area which, even if it's not a high-end affluent area, but there are going to be that 7-year-old couple who raise their kids, maybe have grandkids, but don't need this sprawling home with land, etc. And for reasons that are various. But they will get to the point where they say, okay, well, my home's hypothetically worth $3, $4, $5, $6, $8, $10 million. They will then think, okay, well, I learn my area, I like my area, but I don't really have options at the moment for a downsize in my area, so then I'll have to go somewhere completely different. This will change that landscape because they're like, okay, only 4 streets over now, there's been zoning changes, and there will be some really nice apartment accommodation, which is going to give me all the facility I want. I can downsize, I can stay within the area that I want and know. And developers will know this too, because they'll know that, hey, we're going to appeal to the same people in this area. We're not necessarily just appealing to first home buyers. There are changes in the more affordable markets where first home buyers will buy the entry-level apartments and villas and townhouses that will come out of this. But there's also going to be a big market created out of nothing of those people who didn't really see a choice to downsize, but now will think that's actually a really good downsize option. And I can think of dozens of markets right across Sydney where there probably isn't really a valid option for them to downsize to just yet, which will then give them that upside. So again, winners and losers. But I think one thing that I also try to probably reiterate and people can take from this is that, yes, we're talking about Sydney here, but this is a problem that is manifested over a few decades. Every single major capital city in Australia has this issue either now or is developing into this issue and will result in what has happened in Sydney at some stage in the future. And this comes back to buying and holding long term, because the winners out of this are the ones who didn't necessarily buy in the last year or two. Yeah, there's some upside on those, but those who bought in areas which were close proximity to amenity, that amenity really wasn't that much in demand at the time they bought, maybe 10, 15, 20, 30, 40, 50 years ago. But over time, as density continues to put there and you get more people, more infrastructure, that becomes more premium. And eventually, the government knows, and this is not just Australia, this is worldwide, infrastructure is extremely expensive. And there is a far better yield and ROI to change density in areas as opposed to release new areas. So that is something to take into consideration here if you're investing in property, full stop.
So how will this change potentially where you're buying as an investment strategy? Should you now be considering, if you're looking to invest, areas that potentially have been rezoned for the purpose of land banking?
I don't think it does. Like, I personally don't look at this and think, how does this change your mindset? I think for me, it always comes back down to how can I get the best amount of land with the highest demand on that land, with the money that I have, with the yield that I need to be able to hold this property, and a property type that's going to mean it's got as little overheads as possible and upkeep and maintenance, all those things. So I think all those aspects around the fundamentals, that doesn't change. You buy the best quality property on the best piece of land that you can afford at the time. That gives you the best amount of yield to allow you to hold that property for 10, 20 years and beyond. The rest is a matter of being patient. I think this is actually a really good lesson in what patience brings if you're a property investor. Owner-occupied, different conversation. There will no doubt be people who are going to be frustrated and upset with what's going to happen to the landscape of their local market based on these changes. Unfortunately, that's progress, and we don't have any real say in that unless we want to go backwards as a country.
Yeah. Okay. Well, thanks for bringing that to our attention, Paul. And you said you've got stuff on your website. People
we do. And people can talk directly to us if they've got properties that they think are affected and sort of trying to think, what do I do with this? Yeah, absolutely. Feel free to reach out.
Yeah. And it's not like, hey, instantly there's greater optionality if you actually own these assets. But if you're going to develop, and I think we've been very clear on this, most people shouldn't be developing property. Most developers at some point in time blow their dough because it's tough. So just because you've got now something that you can put an apartment block on doesn't mean you're instantly going to be able to realise that. It's probably going to be someone else that will realise it, but you'll probably get the upsides through some sort of transactional sale, or you know what, you might be able to refinance against it. The bank might view the property.
That's also potential there too. So do nothing, but you've got an upside. So banks eventually, over the coming months, they will see, hey, there's an uplift in value in this land.
Yeah. Okay. Good. Now, also on the pure property news update, fortunately we get together just after CoreLogic normally drops its data in terms of house price movements. Again, things are starting to shift a little bit after a period of probably negative growth in a lot of markets.
Yeah, last couple of months of last year.
So what's happening, mate? What's the news?
Well, I mean, there's some pretty interesting headlines, and probably some here that probably long waited as far as markets that have been in the doldrums for some time. But the headlines are that Melbourne and Hobart, as of the month of February, led the country in regards to house price percentage growth for that month, and both were equal at 0.4% growth for the month. Although it's not huge on a monthly basis, once you start compounding it, it starts to point towards a bit of a different story. Now, one thing I would point out, and particularly with Melbourne, it's its first month for some time in positive territory. Now, we don't necessarily want to see that is not a trend. A trend will be probably seeing 2, 3, 4 months worth of this continuing. But the markets of Melbourne and Hobart have led the way across the country. Now,
0.4%.
0.4% for, and this is obviously excluding yield as well. So just sheer raw capital growth.
Yeah.
Brisbane, Perth, Adelaide, which have been the darling three over the last 2 or 3 years, continued their growth, however, at a slower pace now. So they're at circa 0.2, 0.3%. Yeah. And they're still on track for a really solid 2025, and their 2024, 2023, 2022 have all been excellent. And also in some cases 21 and 2020. But it's now pointing towards, at least some green shoots. And we've talked about this for some time, that Melbourne looked very, very good value. And if I'm honest, probably still looks like good value. Is it booming? Certainly not. Is it showing signs of hitting the bottom? Potentially. And that's what this data is starting to show. Sydney showed a positive month again as well. That was on the back of a couple of negative months, and that was an interesting trend. But across the country's growth sat at circa 0.3% for the month, which was, again, it was bucking the trend of a couple of negative months as a nation of negative growth, which is showing that potentially very, very early stages that this first interest rate cut has had its immediate flow-on effect.
Yeah, and a lot of those price reductions from the peak running up to the interest rate cut, so sort of the back end of September into Feb, a lot of that would have just been sentiment-driven, people sitting on their hands waiting to see what happens with interest rate cuts. But Sydney peaked in September 24, and it's still down 1.6%. Melbourne peaked in March 22. It's down 6.4% since that point in time. Hobart peaked in March 22, similar, same time, 11.9%
off its
peak. Darwin peaked in May 14.
It's bonkers when you start looking at
11 years ago, right? So if you invested in Darwin 11 years ago, you're probably behind the 8 ball.
You're still likely maybe neutral, maybe negative.
Yeah, so that's still 5 odd % down. And Canberra peaked in May 22. May 22 is when the last federal election was. That's when interest rates started. The first interest rate cut was in May. Increase was in May 22, and that was when the federal election was. Is down 7%. So it's not all rosy. Obviously, Melbourne, Brizzy, Adelaide, and Perth are all at their peaks, and they're up. Brisbane's up 90% 10 years. Adelaide's up 93%, and Perth's up 54%. So and Perth didn't really kick in the gear probably 3 or 4 years after Brizzy and Adelaide. So
absolutely.
The pace of growth has been faster than those, but at an absolute level of 10 years again. Time in the market. So the idea is that you wanted to probably be in Brizzy 10 years ago.
Well, I mean,
which I was.
So was I. Yeah. But I mean, what that does point out, and there's probably a pretty obvious thing here, is that the past 10 years, the average, national average is 69.5%. So if you threw a dart at a dartboard 10 years ago and bought the average property in the average market, you're up basically 70%. So putting that in perspective, if you are putting a $500,000 property in your portfolio 10 years ago, you're up 70% on that. That $500,000, let's say it cost you $100,000 to get into that in raw cash or equity, and that property at $500,000 is now worth, say, circa $800,000, then your $100,000 investment has made you $300,000, or in other words, 3xing your money. So, sometimes it doesn't necessarily sound as good, but if you think, okay, if I just took $100,000 and I just put it aside for the next 10 years, do a few emails, do a few tax returns, and essentially then fast forward 10 years.
And what
Would I
you're
be
doing is
happy?
they're talking about one of the great benefits of property is leverage.
The eighth wonder of the world,
Yeah.
and leverage and compounding growth. And
Leverage
and,
compounding.
and
that doesn't take the cash
the
flow,
negative
getting
cash
that,
flow,
you know,
and no, it doesn't take that into consideration. Let's assume there's probably 50 grand out of that might be there. That's 2.5 times, maybe. Let's say of your 100 grand equals 250
you
grand.
might have
return.
got some tax benefits as
Yeah.
a result of it. It's again, it gets
But
it's
there's
very unique.
There's a couple other points here, and ideally we'll go through this every month. But just looking at that past 10 years, and you pointed out Perth was a really good example because people think 54% growth over the last 10 years. Perth's done way more than that.
Yeah.
And yes, the answer is yes. And this is where we talk about time in the market versus time in the market all the time. But this is a classic case of timing the market in addition to time in the market, because the last 5 years for Perth has actually seen almost 76% growth. And then the last 10 years is 54% growth. Now, quite obviously what that says is that the previous 5 years to 2020 was going backwards, and it went backwards quite significantly. But most of these markets, you can see quite clearly that Brisbane, Adelaide, Perth, Brisbane and Adelaide in particular at 93% respectively, have seen the most amount of growth by quite some way. Although Perth has had a fantastic 3 or 4 years, and people start to think, oh, well, it's had such a strong 3 or 4 years, is it peaking? Well, there might be an argument that it's getting closer, but it's still only 54% up on the last 10 years. So it's actually still essentially only second, really. I mean, I'll take Darwin out of this equation because it's a much, much smaller market. Melbourne is the worst performing market on this list over the last 10 years.
Yeah.
And you start to think, okay, well, what does that mean across the board here when you start to assess it all? And if we take that, and I'll just overlay combined regionals, they have outperformed the capitals over the last 10 years, and circa 86% over the last 10 years has been the capital growth versus about 70% for major capitals as well.
I just don't understand how Darwin can be down 2% in 10 years when they've got Crocosaurus up there. Like, you think that press would be booming. I don't know. You been to Darwin lately?
Not lately.
No.
I can't say I have.
I went to Darwin probably 2 years ago.
Really?
About this time 2 years ago. And Darwin's cool, but Darwin's small now. North Palmerston?
North Palmerston
North
North.
Palmerston's like Palmerston North. It's like
North Palmerston. Palmerston North is New Zealand.
Yeah, North Palmerston. Well, that's a big-ish city now. But you sit there and just go like...
Crocosaurus.
No, Crocosaurus is on the main drag.
Oh, gotcha.
It's where you go in a little bubble and you sort of...
I'm not going to act like I know what you're talking about.
No.
But anyway, you're obviously very excited about Crocosaurus.
Well, I didn't actually go because I refused to pay.
Refused to
the money. I looked at the sign.
Do they know who you are?
I don't think I mentioned to them who I was, but
a missed opportunity.
I do like Darwin, but and Darwin's a really interesting. It always gets forgotten about when people talk about property markets because people just go, "It's such a small town. Why would you be investing in why as a property investor would you be investing in Darwin?" Is the question. And I look at this and say, imagine if you tied up your dough.
Yep.
So that same 100 grand that you tipped in to get into a property. Imagine if you tied up your money for 10 years with leverage.
Yeah.
So you're paying debt against it. You're really behind. You're really behind.
I'll share this with you. I've got a client of mine who's probably listening to this as we speak. They only just sold a property they bought off the plan in Darwin. I believe it was 2015. And I've been working with them for about 8 years. We've bought one property, but they've been tied up with that property to not be able to build the portfolio. And we've been trying to find ways to get that property moved on to free up. So they went from the value of this property, I think they paid a sticker price of high sixes at the time. 2015. A unit.
Down on the waterfront somewhere? Yeah,
in a complex, not on the water per se, but at the peak. And that property went down, I think it went down to circa mid-4s at the bottom, and they've only just offloaded it somewhere in the 5s. The only reason they could offload it is they've spent that time to actually reduce the debt, use the equity from the other property that we did buy to use that to then offset that debt to then offload this property to let the banks offload it. So it was an opportunity cost exactly like you've outlined there. Massive opportunity cost, but we get to the point where we're saying, okay, well, has the past 10 years, is the next 10 years going to be exponentially better, and is there justification to hold this property? From what I can see, no. We need to get rid of it.
Bittersweet,
yeah,
no doubt. How old are
they're
investors?
like mid to late 30s.
Okay.
So they were go-getters at the time and thought they were doing the right thing.
So why did they buy a place?
They
in
lived
Darwin?
there,
Okay.
right? They lived and worked there,
Yeah,
and that was it, like that. And at the time, you get swept up in the hype. You see, at that time, it was a boom.
Yeah.
There was oil and gas. There was a lot of federal infrastructure spend. I think there was a lot of defence spend. Talking about a whole bunch of other things at the time. That just it's still remained a relatively medium-sized regional town.
Yeah,
at
and
best.
you put it in perspective, Townsville.
Yeah.
And Darwin, I can't imagine their towns will be smaller than Darwin.
Yeah.
But
Not by much.
not by a lot. So there's probably commonalities and similarities in there, right?
Yep.
All of the data, like all this sort of decision-making data that property investors can use these days, telling everyone to invest in Townsville, right? There's going to be a lot of people. Like, I like Townsville, and the federal member up there is a great guy, and they're humming along right now. That they copped the cyclone recently as well. We spoke about it last time we got together. But for property investors, there's going to be a lot of property investors who buy up there at the peak, and you're probably going to get a similar scenario to Darwin, where it's just going to plateau.
Exactly.
I can't see it sort of just dropping, because it's quite a diversified place, Townsville, and it's got quite a lot of infrastructure and spending stuff, but. Just be careful where you invest.
I would tend to agree with you, mate. And no offense to anyone who owns property out there, but if you're putting 450, 550, 650 into a market right now, and you look at where and what that future 10, 15 years has ahead of it, don't get too carried away with a 5% gross rental yield when you can maybe get a 4.2% elsewhere in a major market that may be in a much, much lower point in its cycle with a much bigger long-term predictable outcome coming its way.
And Canberra, again, it's its own unique market. Like, a lot of the rules that apply in other areas don't necessarily apply in Canberra, and Canberra has feast and famine. That's down 7% since its peak, but it's grown 60% in 10 years, right? So I would look at that and say, it might be worth exploring or considering, having a nose around that, because there's something not right there at the moment, and obviously Melbourne. We sort of spoken at length about that, and we're just about to launch the Smart Property Fast 50, and no doubt I think there'll be some Melbourne. We don't want to give too much away, but we're doing that in partnership with Fuel Property, so watch this space. But Sydney is of interest to me, coming off its peak, so maybe it's some good times in Sydney in the right market. There's certain areas of Sydney which are still getting out to the sort of the western and southwestern fringes, which are still moving pretty well.
Yeah, and like we could spend all day going through all the CoreLogic data that comes out on a regular basis, and my team and I do on a weekly basis look through, because they're always releasing different data. But one real interesting thing that I'll probably finish this part of data off with, and this is probably word to the wise for anyone who's investing in any market and has done so for the last few years and trying to understand where and what and how, is that it's not necessarily going to be specifically the middle and inner rings that are outperforming. The trend that we've seen consistently since 2022, and this is no coincidence that it's since the start of the interest rate rising cycle, but also this cost of living pressure, which is not going away anytime soon, is that the bottom 25 percentile markets in every single major metro and regional market have outperformed the middle 50 percentile and the top 25 percentile, and in some cases 2 to 1. And what that means for layman's terms is that if you've got Sydney as an example, it doesn't mean that Sydney's going backwards. And you've seen here that Sydney's peak was in 2024, September 24, and it's down 1.6%. The actual 6 months has shown that those more affordable markets, the bottom 25% value markets, freestanding houses, have actually seen growth. And in every single market, I think it was except for Darwin over the last 3 years, the bottom 25 percentile has outperformed every other market segment from a value standpoint.
So is that typically where you look to operate down? I guess the affordable, because there's a good reason why that market performs maybe stronger, because you just inherently have more buyers. Because you have first home buyers.
Demand,
and you have property investors there. That's where they operate, and it always has been that. We were a decade or so ago when we were buying out western suburbs of Sydney. That was the bottom
It's still the
25
bottom 25 percentile. Just because
know.
it's 3x doesn't mean it's more expensive than 4 markets in a closer city.
There is just greater demand for those properties because that's what people are going to afford.
And that's the same in Perth. It's the same in Adelaide. It's the same in Melbourne. It's the same in Hobart. It's the same in Brisbane. It's the same everywhere except in the data. And it's only by, I think it's 0.1% than Darwin. Canberra's the same. So it's not a coincidence. It's not a coincidence that the more affordable markets have more demand and actually have seen a higher percentage of capital growth. So anyone who tells you must buy blue chip and you're thinking I have to sit on the sidelines for 6 years to save up way more money to enter into the more premium markets and miss out on all this opportunity that I could otherwise get, go with the data to prove yourself either right or wrong. Don't take perception or opinion. There is a lot more fact out there than what there ever has been. And that is a big resounding one for me, is that the more affordable markets have outperformed, and I dare say over the next 5 years they will continue to do so because money's going to get a bit cheaper, but it's not going to be anywhere near what it was, and prices of property aren't going anywhere other than up, and incomes aren't going to keep up with where we need to see them to be to allow that middle ring in particular start to boom again. It's a ways off.
Yeah, and there's a lot more forgiving down there as well. If you need to offload your properties, you've got a lot more buyers.
There's a lot more, generally speaking, better yield when you're looking at it versus the debt you're going to have
from
on the
a
property.
point towards migration as well. Typically, that's where most
First 2 years.
First 2 years, new to Australian migrants, whether it's in Sydney, Melbourne, Brisbane, wherever. They're the stuff that they rent. So there's good reason for it. Now, well, let's touch on it very briefly as part of the Pure Property News update. It's been done to death around interest rates. A cut late last month, first time in 3 years, it's coming down rather than up. As we said, May 22 is when they started going up. 4.1%. Next cash rate, the next time the RBA meets is just after what I think is going to be the election.
Yeah.
And then meets again in May, by memory. And whether or not we're going to get a cut there. What's all this mean? Does it really matter that much?
I don't think at this stage it matters an awful lot. I think, you can look at what your banks are offering you and what they're putting forward as far as some fixed rate options, and that'll probably give you a bit more of a bellwether to understand what's going to happen over the next 12 months, 24 months. I think one thing that is almost probably going to be a consistent, though, is that the affordability, albeit does increase very, very slightly. I think what will be interesting is for anyone, and we'll do this news and we'll look at the monthly data that comes out of property price growth, people will probably start to see what direct impact of an interest rate cut does to a property market. And I wouldn't be surprised if we see something similar in the next month, next 2 months, next 3 months. And it's just a little sugar hit from what happens when you see interest rates cut. It's just slight more affordability. More people who are on the sidelines are going to jump in, fear of missing out, and a range of other things to go with that.
Yeah, and it's a sentiment mentality thing at the moment. I think I spoke to Eva over at Finney Mortgages, and she said that the interest rate cut means about $12,000 more in serviceability for most people.
Yeah,
it's not a big deal.
No,
but we'll keep an eye on that and give some commentary analysis of it. So that's the Pure Property News update. Now I've got some questions rather than getting some other stuff. Some questions from our readers and listeners over the last sort of couple of days and week. And the first one here is around the cyclone. There's a few of them coming around this, and they're. I don't know. I'm sure you've got it as a property investor. All the properties I've got up in Queensland, I must have got an email from every single property manager saying, "Hey, there's a big weather alert."
Down the hatches.
Insurers have stopped writing policies at the moment.
Yeah.
So I'd go and have a look at your insurance policy when it comes due, because some of them might be reluctant to. I've got one actually renewing on the 24th of March.
Yeah, right.
And it was high already.
Yeah.
So I've already got I'm just thinking, because I've actually given it to another broker to try and get it shopped around for a cheaper price, and they've gone, we can't issue any insurance. So I've got to play that game at the moment, whether I've got to pay it. But they always put the insurance in place and they give you a month to pay it anyway.
Yeah, exactly.
It's a secret that probably they don't want you to
the old cover note.
Yeah, cover note. So you're in place and you pay it if there's a problem. But what do we need to know about the cyclone? What does it mean for property investors?
Well, I mean, look, we could look through the ages and say what happens when you get these massive weather events. Now, weather events have happened. Obviously, you saw the one up north of WA, which was a very, very dramatic Category 5 cyclone. However, it's a very remote area, so it had very little impact on major infrastructure. And then obviously we saw North Queensland around the Townsville and surrounding markets. That definitely saw more inundation and what happened with that there. Now, it didn't necessarily exceed any previous records. So I think what was expected to happen kind of was within expectations. So there was nothing that I think was overly dramatic there. I think what we're about to experience, and probably once this hits the airwaves, it's probably already happened, unfortunately, is that this, from what I've seen, is not necessarily been precedented until, or previously was 1990, give or take.
Yeah.
This is something that's not a common thing.
And as we speak now, I think it's tracking directly at Brisbane.
Yeah, Brisbane, Gold
Noosa,
Coast, down towards Ballina and the Tweed.
Yeah.
And the depending on what happens here, places like Lismore, which has just been hit and hit and hit, will likely be hit again. That being said,
so there's going to be flooding. There's going to be
flooding. I think by the looks of things, it's probably more what happens with the water here and what happens after that and the outcome of that. But for property investors, Bill, you and I invested in, and I'll give this example. We invested in Brisbane in, say, circa 2014, 15, 16. We forget quickly that not the 2022 floods, the 2011 floods that affected the broader Brisbane market, they were major. And if you go back through the archives and just Google the 2011 Brisbane floods, you'll see stuff that you just think is unfathomable. There was
like things flowing down the river.
Literally, there was bridges that were covered. These are major arteries that were covered, and there was some very, very big impacts. There was big floods. This was a proper 1 in 100 year that had direct impacts, changes legislation, changed zoning maps, changed flood overlays, all those types of things. What happened after that? There were some significant changes, because I can think of markets like out towards the broader Ipswich market, the river that snakes all its way through there. There were new subdivisions that were built prior to the 11 floods, but they were built after the 1990 floods. I'd have to, and don't quote me on that, but there was a major flood event prior to that, and there was flood overlays that were put there. Now, where I'm getting at with this is that there were new subdivisions that were completely inundated with water. There were properties that were completely flood affected. And to be honest with you, those properties, they saw a massive hit in their value. And it didn't happen overnight. But what did happen, as far as the flood, obviously they had insurance. Almost all of these properties did have insurance because they were covered. However, the value of those properties incrementally dropped over the next 2, 3, 4, 5 years. What happened, though, is that people forgot, and they also thought this would be basically a once in a lifetime event, and people forget. And then all of a sudden those properties tracked up really dramatically as far as value is concerned, and they're kind of trending in line with streets and streets over, which were not necessarily flood affected, because you did see for a period of time was impacted by the 2011 flood in every one of those sales. You don't see that on those same properties anymore. They transact now with the same properties that were flood affected in 2011. That doesn't say that these properties were flood affected in 2011. Now, whether that's legislation or not is another story. But this will be something that comes out of it. So for me, the ongoing adage about understanding your due diligence when buying property, i.e. making sure that you know your flood overlays, you know all of the other overlays with regards to bushfires and arteries and infrastructure, etc. That is the most important part here. You can't change what you already own. You're not going to sell it in the next couple of days. So effectively, if you're looking at buying, whether it's in Brisbane, whether it's in New South Wales, whether it's in any market, there are flood-prone areas in every single market across Australia. But due diligence is always going to be key. Does it affect your value of your property if and when there is a flood event? Absolutely it does. Does it affect your insurance premiums? Absolutely it does. And this won't change. Just don't get complacent if you go through a fair weather event or a period of time for 5, 10, 15 years where nothing happens. You need to be diligent on this. If you plan to hold a property for 10, 15 years, you need to be diligent. And I'll point one thing out here, Phil, and you might have seen this, and the headlines across Australia probably grabbed this too, is that there was a block of land in Byron Bay on the beach that sold, I think it might have been late last year, for $20 million. It had a shack on it, tin shack.
Yeah.
A prominent Brisbane high-end developer bought it, and they're going to be building something very, very dramatic on that property, and it's going to be a literally one of the best properties in Australia, coveted, etc. At this stage, before this is hit, we don't know what's going to happen to that. But if you look at it on a map, and it doesn't take much of genius to figure out where it is, will that be affected by this king tide plus unprecedented potentially swell event that's happening?
King tide.
There's a king tide. Yeah. So, and this is typically what happens with these cyclones. You got to think like you're not, just because you're not inland by next to a river, you're not immune to this if you're on the coast as well.
Oh, yeah.
And this is some of the biggest unprecedented stuff. And that property, $20 million for a level block of land, if it was up on a cliff, different story. But this thing is literally a couple of meters up off the beach. And you start to think, how does this affect the coastline? How does this, we've seen it in every single city, or the east coast of Australia's seen it. The 2016, we had a huge low that affected the whole Sydney coast, a massive swell, and that affected particularly the northern beaches a lot. And there was years and years and years that they had to redevelop all of that.
Well,
there is so many effects.
There's outcry at the moment around that sort of Coleroy,
Correct.
Narrabeen, South Narra area, where they've put the first instalment of a seawall through there, and it's big high sandstone.
And that was from 2016 event.
And there are so many people who are just going like, most people go, we don't want that. Right, they go, let nature be nature.
Yeah.
And,
it's
really only the people that own the property what the seawall
$10,
is,
$20 million properties.
Yeah, and the biggest issue is that they expect the government to front it up. Right?
Correct.
A lot of the cost around it.
Yep.
And the argument being, well, why should all this government money go into serving probably the more wealthy than everyone else?
Thin edge of the wedge.
And it's wrecking brakes and stuff, and all that. All the servers aren't happy and all that sort of thing. So it's a big deal. I remember we looked at buying a place up in on the north entrance. We put an offer in and it was accepted, and it went for a period of DD, and I was like, fucking.
It's because you got a lake on one side, beach on the other side, and you're like, what does it take? It takes a king tide followed by this kind of event that pushes lower than normal.
It's already all cut away, right?
Yeah.
So it's only a matter of time till it all cut out. So the whole of, I reckon, the east coast of Sydney, it's all creeping. East coast of Australia, it's all creeping in. So those
the low-lying sandy areas, they're always going to be most
which are
affected.
dunes, right?
Yeah,
and they
absolutely.
move. Dunes move around. But anyway, so it does matter. This and we don't yet know how this is going to play out. So it could be tough for people. And we'll obviously debrief after the cyclone comes through, and there'll be some property stories off the back of it. But it's a really good sage reminder to ensure the insurance is up to date, that you're got the right amount of insurance rather than being underinsured.
Yep.
There's a lot of people are underinsured in investment properties. I was looking at stuff the other day, and I was like, really, is that all this is insured for?
Yeah.
And I went, there's no way in the world. It was an apartment block up in Brisbane, and I think I went, you couldn't build a house for that much, let alone.
What was it insured for, if you don't mind me asking? I know the property.
1 point something.
And that's five apartments.
Five apartments.
Yeah.
You wouldn't be able to build it.
No.
Like, it would cost you.
Well, you got to demolish it as well. Like, there's the things like
probably that's just to demolish it and clear the site is probably about that much, right? You know. So it's I would say it's underinsured, but then you go, well, what's the likelihood of something happening? I don't know.
This is a big problem that I think it's a very, very immediate and sage reminder for anyone who owns an investment or multiple investments is that my best advice in this space is an insurance aggregator, essentially an advisor in that space. And it's much the same as a mortgage advisor, is that going directly to your insurer and speaking with someone on a switchboard, you are rarely going to get the best outcome for yourself and the best cover. Don't worry about the best price for the time being, but worry about, are you going to be correctly insured with the correct excesses and the correct cover, and then shopping it from there. I personally work with an insurance aggregator. You do too, Phil. And it's not because I want to get the best deal all the time, but I want someone to say, here's the property. They'll go around and figure out, here's the people I'd suggest you work with. And also in these events, don't underestimate what it takes the benefit of giving one person a call who's not a random switchboard that you're going to sit on the line for 3 hours with and say, hey, I've got a claim here I need to put through. Can you please sort it out? Hang up the phone, and they say, let me do it for you. There's a lot of value in that.
There's a lot of good brokers out there, insurance
Absolutely.
brokers. I would echo those sentiments. And it's crap doing it as well.
It's the worst kind of work.
It's the worst sort of it's give it to the experts.
Yep.
And then I look at some of the other stuff I've got insured and I go, it's actually insured for what it should be. So it's not underinsured.
Yeah.
But then I sit there and just go, am I overinsured? Like that, but then you sit there, you sit there and go, the likelihood of this happening is,
and me saving $250 a year, and then all of a sudden you're like, is it worth it? And like you don't need it until you need it.
You don't need it. Now there's another question here around affordability when you look at sort of Melbourne, Brisbane, Adelaide, Perth, Canberra, Sydney. We sort of touched on that prior to, so I don't really want to go into that again. We spoke about the bottom quartile, maybe as an area for targeting. Now, what I will pick up from that is that you sort of spoke about this notion of, inverted commas, blue chip. So in that bottom quartile, there will be blue chip assets inside that bottom quartile. And this is a perspective thing, right? So if you think about if you're investing in the bottom quartile of the city market, you're probably going to be investing in places like Campbelltown, maybe.
Yep.
I don't want to generalise too much, but it'd be
This is price. We're not talking about perception. We're just talking about the price.
Campbelltown, Mount Druitt, Western Suburbs of
Penrith,
Sydney,
St.
all
Mary's,
those
whatever.
areas, right? It's bottom quartile.
Yep.
And you're still looking at probably $700,000-800,000.
Oh,
getting those
for a house,
price
that
rounds.
would be land value in almost all instances.
Yeah, that's good buying at that, right? But there will be blue chip assets in and around, say, St. Mary's, for example.
Absolutely.
Right.
There will be A grade, B grade, D grade in each one of these markets. And that's
so it's still good to chase blue chip assets in and around the at a suburb level.
Yeah, and that's exactly it, Phil. And that's probably the best way to think of it, is that like you're trying to chase, and whether you say blue chip in a bottom 25 percentile, or if you say A grade or B grade or C grade in those, that's what we're looking for, is that typically trying to find within the budget that we have to work with, within the constraints of the cash flow that we need to achieve to get that working for that particular strategy. Yeah. That's always what we're looking for. And then ultimately, are we getting value? Because if there's an A grade in a bottom 25 percentile and it's priced correctly, is that good buying? Well, it's debatable. You still want to be able to say, well, am I getting this at a good price? Now, you're never going to get bargains for things that are obviously really good quality properties, because too many people are too wise. But to your point, there is still A grade markets or A grade properties within bottom 25 percentile markets every day of the week, and that's in every single suburb.
And you could probably speak to this. One of the great tactical approaches for property investors is go and secure those C grade properties in and around those areas where you deem to be good buying, and turn it into an A grade property.
Yeah.
So the uplift, the equity uplift and the arbitrage uplift on, if you can get a C, turn into an A by spending a few bucks.
Yeah.
You can increase your value quickly. And when I started investing, that's largely what we did.
Absolutely.
We were investing in bottom 25 percentile properties.
Massively.
We weren't buying the best properties in there.
No.
We're probably buying, I wouldn't
probably
say the absolute
C and
worst,
Ds.
but C and Ds, and we're turning them into Bs and As.
Yeah, and I think probably the split out of that, and just for people to start to think, well, how would this work for you practically, is that you can look for B, C, D type of grade property, but ideally getting A or B quality land. Because to add value to the land is really, you can't change the location of the land. You can't change the size of the land. You can't change the proximity to amenity of the land. Yeah. But you can buy that land with a dodgy looking property or something that might need a fair bit of freshening up on it. That is achievable. You can't change the land itself. So it might be trying to find that hybrid approach to say, yes, I'm happy with just putting a bit of paint, carpet, blinds, yard tidy up into this B or C, knowing that I'm buying an A or B piece of land and the price looks right, the yield will be good.
And the land might be an A because it might have just been rezoned. You just don't know.
Yeah,
right? So
absolutely.
There's a lot of
and also, there's plenty of people who just want to say, I don't want that. And that's absolutely fine as well, because you can just say, look, park it. Here's the best property in that location. You're going to pay a slight premium for it, but you're probably going to get better tenants. You're probably going to get more longevity of consistent growth and less fuss. And that's an okay strategy as well if you're looking for a 15, 25-year-old 4-bed, 2-bath, 2-car garage house in just a good quality, predictable
lowish
area.
Maintenance.
Yeah, still in that bottom 25 percentile market though.
Yeah, so this idea of blue chip, it's all relative depending on where you are. So blue chip in Neutral Bay, like there's a lot of not blue chip places in Neutral Bay, but there would be an argument, and the base sentiment is, well, Neutral Bay is a blue chip location.
Correct.
That's the mindset.
I think we've uncovered something there that probably doesn't ever get discussed, Phil, in the sense that blue chip is a truly overused term. Yeah. But when we're talking about percentiles and then A grade property or B grade land with an A grade property or vice versa, there is a lot more complexity to it. And I think people just think if I buy in this suburb, it's a license to print money. Incorrect. It's a fallacy.
No, and if you're able to afford higher value properties in good properties in blue chip locations, right? The aggregate of its growth is going to grow faster than what it would do if you're buying in a lower, more affordable location.
Yeah.
So this is the argument about blue chip, is that if I can get 50% growth over 5 years in a more affordable location, bottom 25%, and if I can get the same percentage growth in a top 25%, you're going to make a lot more money.
Correct.
In the top 25%. Correct. So a lot of it's going to come down to your capacity.
Exactly.
To borrow money, service debt, where you are in your investing career. So it becomes quite a tiresome discussion when all there is people saying you should only buy blue chip properties, in inverted commas, more expensive properties. Most property investors can't. Most Australians can't.
They can't, no.
So therefore, most investors largely can't either.
And same as owner-occupiers, same as upsizers, downsizers, they're typically not going from a 600 grand property to a $1.4 million property in one step. It's certainly not happening. But I guess the big thing that also reiterates here is that hypothetically, if you can afford to buy a $3 million property in a blue chip market, well, that also tells me that you can afford to buy, and I'm not suggesting you need to do this, but you could potentially then go and buy 3, 4, 5 assets in that circa $500,000 to $800,000 price points. What the data's telling us is that the bottom 25 percentile is giving us a higher value percentage growth and also better yield almost always on average versus the higher end or the top 25 percentile market and even the middle 50 percentile market. So this is the challenge, is that one property, will it do the same if you bought this equivalent value of a number of properties at a lower price? Well, technically, the data showing that no, it's not. The high value property is going to get lesser percentage capital growth, and it has done so for some time and lesser yield. Now, yes, you have more hassles. You have to buy more property. You have more paperwork. You have more things to do with that. But the net return over time has certainly proven to be better consistently in the past 3 or 4 years in particular.
Okay, all right. We've got one more time for one more question here, Paul. And it says sort of Perth, Brisbane, Adelaide, they're still strong and growing consistently. We sort of saw that in that CoreLogic data with sound rental growth, but not growing at the 12 to 20% per annum rates of the last sort of couple of years, right? So you look towards Perth in particular, I would say, but Brisbane, Adelaide, they're not growing at the same speed.
No.
So what are the pros and cons of putting your dough into those markets today versus other places? And no doubt, Brisbane, Adelaide in particular, are probably inverted commas safer bets. You know, it's not going. You're going to have continuity there and consistency, but it might not be if you're chasing super accelerated equity uplift quickly. Might not be the right places. And I'd certainly say Perth is part of that. So what do you do, mate? That's the question.
Yeah, you got to really take a bit more of a longer term mindset, because if you haven't entered into any of those markets yet, you got to say, okay, well, whatever happened in the past 1 year, 5 years, 10 years is irrelevant if it doesn't affect your growth. Well, essentially, it's not your growth; you're buying someone else's growth. So you've got to then say, okay, well, Perth and Adelaide and Brisbane, as an example, grown circa 90% in the last 10 years. Historically, and I actually have a section in my book picking a location, and when I go through data over the last 40 years and I break it down into 5-year segments, each one of these major cities, you'll notice that almost unequivocally every single 5 years, the market that does the best is not the same market the next 5 years, the next 5 years, the next 5 years. What I'm trying to get at here is that, is Brisbane and Adelaide in particular going to be the best performing markets over the next 5 years versus when we talked about that CoreLogic data, they've been the best performing over the previous 5? I would doubt it. So my point here is that just because the past 5 years have been excellent, is that meaning that the next 5 years, 10 years is also going to be so? Highly doubtful. And that basically comes down to affordability being constrained. The markets themselves, the dynamics around them are still okay, but we're seeing that they just can't afford to keep pushing up the same level. Perth is only 50% up on the last 10 years. It's slowing a little bit. However, there's probably more propensity in that if I'm looking at the next 5 years personally. Melbourne, as we've already articulated, is probably a market that has shown over the last 30 years really good, strong performance as far as consistent capital growth, but had an extremely average 5 years and a particularly average 10 years. So you start to think, where is my money going to make me more of a compounding, predictable outcome over the next 5-10 years? Well, I've sort of given a few different clues there as to where I think it, but you've got to overlay yield with that as well. And that's a completely different story, and it's not necessarily the same correlation, because Melbourne's still going to give you less cash flow than Perth or Brisbane or Adelaide.
It's comparatively a lot more expensive to hold property to get the growth.
Correct.
What it has been.
You've got to afford to give more away to get more in the long run.
Yeah, as a ratio of probably earning capability as well.
Yeah.
So it's again, everything is completely individualized, and sort of throwing blanket sort of commentary on a lot of this. It all depends on who you are, what you're doing, where you're at your investing journey, how much money you've got, your ability to service debt, how you live your lifestyle, what your family budget's like, what your plans are, what your strategies are. You know, it is absolutely individualized, and something I'm very conscious of recording these type of podcasts is that, It's certainly not advice by any means. And,
No.
and we're not in the business of providing advice by way of a disclaimer. But you need to get orientated with the right strategies for you based on what is right for you. So blanket applications of strategies don't work.
Not at all,
You
mate.
need the uniqueness. And what I find is, unless you've been in and around property for a bit, and you know it, you can probably work it out yourself. But most people initially probably need some help, I would say. That's probably why they come to blokes like you, I would imagine.
And this is where I spend tireless amounts of hours just working with clients on a weekly basis, is doing these individual particular sets of strategies, because everyone that I speak to is different, and that strategy, the criteria and everything that we get out of that conversation is always going to be bespoke to them.
So you've been doing this now for a decade?
Decade,
Yeah. So do you think people are in more of a hurry today than what they were a decade ago in terms of property investing?
It's an interesting question, mate, because that is probably the downside to getting really good results. And not to toot my own horn too much, but the last 5 years, the last 10 years, if I look at any property that we've bought, we've had exceptional outcomes. And that hasn't been because we've bought in the same market and that market's boomed and we've got everyone winning. We've bought in every single market in Australia except for Darwin and the Northern Territory in the last 10 years. And in some cases, we've bought in 2 different cycles over. The challenge comes now, though, and I always have to try and temper expectations, because I always like to refer to long-term trends, because I want people to expect, if you buy, expect long-term average annual returns, which is circa 5 to 7% compounded annual growth. And yields will be different depending on the markets. But people do see stories of Perth did 20, 25% last year. Perth did 20% the year before. Well, where's going to do 40% the next 2 years, Paul? And I want to buy there. Well, if I told you that buying this market is going to do 40% the next 2 years, I tell you what, I would personally want to put myself out of a job, because anyone who's telling you that, I'd run the other way. And this is the hard part, is that you need to always think long-term with property. Property is not a fast-moving game, and that's a good thing if your mindset is long-term. But if it's short-term, there's plenty of other ways to put your money in if you want to get a white-knuckle ride. But I still reiterate that I don't want people to buy property for those reasons. It's simply just not realistic or achievable.
You've got to temper expectations, and people are in a lot more of a hurry today, because I think they're just peppered constantly with, and they've always been around. They're just a lot more accessible. These stories of the outlier stories of like excellent results have become normalized, and people have been conditioned that outside of what is considered the normal result doesn't happen very often, and you only hear those things occasionally. However, you would assume as a property investor it happens all the time.
It definitely doesn't. And I can attest to the fact I literally have spoken with thousands and thousands and thousands of property investors, and I can probably count on probably one hand anyone who's got more than 20 assets in their name that I've spoken to.
Really?
That I've personally spoken to. We've created a few, but I'm talking off the cuff. And we work with 7-figure income earners, PAYGs, business owners who earn extremely good money. And even still, like the large, extremely large property portfolios, they're not only hard to achieve by the means you need to earn to actually get the serviceability to buy these assets, but they're also hard to achieve more so from a logistical basis. It's not just, hey, do you earn heaps of money and can you buy lots of property?
It doesn't happen in isolation. You got to work hard, you got to be focused.
No, I mean, mate, I own dozens of properties personally, and they are difficult to manage, very difficult. They take ongoing work, maintenance, time, everything that goes with it. And that's been a life's work, basically, from my professional career. It's taken me now to 42 years of age to get there. And I feel like I've probably on one of the inside lanes to get there as quick as possible. And I know you speak to others who have got hundreds or at least dozens and dozens of properties and talk about expanding it. You can, but man, either A, you're going to be a very busy person, or B, you might be a pretty average landlord. And I don't want to be either, if I'm honest with you.
Average landlord.
And that's it. I hold my title as a landlord and a property owner, a property investor, and someone providing accommodation. I take it seriously.
You're just a struggling provider of short-term rental accommodation, long-term rental accommodation.
Long-term rental accommodation, mate. You and me both. But I'm sure you're the same, Phil. It's like,
I'm going through it now. It's
Yeah.
just sort of like,
and there's a moral responsibility. You're like, I need to provide this. I know this is realistic. I'm not this person's. I mean, you do get tenants who, for whatever reason, ask for things, and I've been a tenant for a long time personally as well. And I know when tenants are taking the mick, but most of the time they're just genuine people asking for something that's not unrealistic.
my air conditioning's broken.
Yeah, my hot water heater doesn't work.
Yeah.
I've got this, I've got this issue with regards to my fence constantly falling over. Well, we need to get that propped up because there's dangers. You've got kids playing in the back.
Yeah.
There's stuff that happens all the time, and this is property ownership. This is part of the course.
So, cyclone happening right now. We'll wrap that up, and I don't know when the surf's going to go from being really good, because I reckon it's like going to double from where it is on the sort of Tuesday and Wednesday of the storm coming in. It's going to get pretty bad up there, but
and down here,
down
here in Sydney. Like,
is the Surfer's Guide to Property Investing, the next wave, going to be able to ride
the next wave,
the next wave, the big wave,
the
everyone getting ready
wave.
to go. What, Wedding Cake Island or fire?
Oh,
and,
all of them, all the spots,
and what do you call what's the reef at Shark Island?
Yeah, all Shark Island. Yeah, Shark Island doesn't hold probably much beyond 10 foot.
Point can handle it.
Oh, there's plenty of points right up and down the East Coast. They're going to handle some good times, some big east, northeast exposed areas. Everyone knows those spots. Surfers know where it lights up in these types as well.
But you went on a surf trip last week and you missed your timing.
We got a little bit, but we were a week early. Yeah,
unfortunately,
we're a week early. We missed it.
Jokers. All right. Well, anything else for us?
No, mate. I think like we're in the point of this is the busy season. If you're looking at acquiring, this is acquiring season. Like between now and probably leading up to the election, I'd want to see people make moves. If you can do it, do it. Get your finances in order, because it's probably the best time to speak to your broker. That best time that's been in the last 2.5, 3 years, because you'll find that there's more money available. The likelihood is you've got more equity in the assets if you hold them already. And there's probably a chance to actually recycle that, get that in there. There are certain markets that, personally speaking, we're really starting to get very busy in, which I'm very confident the next 5 to 7 years are looking very good versus where they have been. So purepropertyinvestment.com, people can reach out, grab some time with me in particular to go through, firstly, that strategy, set that, and then get busy, because for me, this is busy season.
Go time.
It's go time.
It's go time. All right. Well, thanks for coming in, Paul.
Thanks,
enjoy the chat. For the Pure Property Podcast with our new section, Pure Property News Update. So we'll do more of that. That's good. It gives us, there's a lot of questions come in, but, the immediacy of how we can help interpret what's going on in markets and maybe help you shape your decision-making is what this is all about. Lots of other episodes of the Pure Property Podcast. You can find it wherever you are. And please keep those reviews coming in around the Pure Property Podcast. Myself and Paul get a kick out of it, but Paul's team also sees it, and they're largely the people doing all the heavy lifting behind the scenes.
That's probably a good point, Phil. If anyone can whack a 5-star rating, that'd be greatly appreciated, because ultimately with the algorithms, the way they work, the more of those ratings come through, the push higher up this pushes, and then the more people get to listen to it. And for me, that's like pushing on good source of truth information for the property investment community of Australia. I love it, and I want to do more of it, but I want it to go to more people. So if you could be kind enough to push that 5-star review, that would be greatly appreciated.
There you go. All right. Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.